We are taught from a young age to view banks as highly secure storage facilities. You give them your money, they lock it in a vault, and they keep it safe until you need it back. The standard explanation for how they make a profit builds perfectly on this idea. It is called the net interest spread. You deposit $100. The bank takes your specific deposit and lends it out to a borrower at a 6% interest rate. They pay you 1% for the privilege of using your money, and they pocket the 5% difference. That traditional vault and lend model is a complete fabrication. Treating banks as passive intermediaries waiting for your deposits to fund their operations obscures the mechanisms they use to generate billions in modern financial markets. This 2014 quarterly bulletin from the Bank of England states explicitly that banks do not act simply as intermediaries lending out deposits. Furthermore, the amount of central bank reserves does not constrain how much a commercial bank can lend. Instead, they rely on what economists call fountain pen money. When a bank issues a mortgage, they do not hand over pre-existing currency. The act of lending actually creates a matching deposit out of thin air. The loan creates the deposit, not the other way around. When lending creates deposits, the bank's primary role shifts from storage to production. Every digital dollar created this way serves as the starting point for a system of interest, fees, and market spreads. This balance sheet diagram shows what actually happens the moment a loan is approved. The bank types a new loan into existence on the asset side of its ledger, which simultaneously generates a brand new digital deposit on the liability side. Look at that new loan on the asset column. The bank is now charging high interest on digital money it just minted, while paying very low or zero interest on the corresponding deposit. That gap is their primary profit engine. This concept of capturing the spread dictates operations far beyond standard loans. It drives private banking, and it heavily dictates foreign exchange, or FX markets. When an internationally mobile client needs to convert large sums of currency, FX dealers quote them a price that includes a hidden spread, the invisible gap between the market's bid and ask price. By holding a slight cushion of risk on these large transactions, dealers capitalize on market momentum, turning fractional currency movements into massive revenue. The spread works because it allows financial institutions to extract a tax on the movement of money across all tiers of the economy, without the client ever seeing an explicit invoice for the service. That invisible tax appears again in interchange fees. Every time a consumer swipes a debit or credit card, a small percentage of that transaction is extracted from the merchant and routed back to the bank that issued the card. Neobanks leverage these interchange fees with high efficiency. By issuing cards through an app-only model, they capture this revenue while operating without physical branch infrastructure. These platforms also utilize float. Float is the massive aggregate pool of stagnant cash sitting in customer checking accounts before it is spent. The bank pools these deposits and invests them in short-term, low-risk instruments for pure yield. At the very top of the wealth spectrum, private banks operate their own elite toll booths. They charge assets under management, or AUM fees, which are flat annual percentages levied on ultra-wealthy clients simply for holding and directing their capital. Banks generate revenue even without a customer borrowing money. Simply leaving capital in their ecosystem guarantees them a continuous baseline profit. There is a ceiling to the traditional lending model. Holding thousands of loans on a balance sheet ties up a bank's regulatory capital. Eventually, they run out of room and have to stop lending. To bypass this, the industry shifted to the originate-to-distribute model. Instead of holding a mortgage or a student loan for 30 years, a bank bundles hundreds of new loans together into a single security and immediately sells that security to third-party investors. Offloading these loans instantly frees up the bank's capital. This allows them to originate a fresh batch of loans, sell them off again, and collect continuous underwriting fees on every single cycle. This cycle transforms the institution's balance sheet. Instead of acting as a terminal for risk, the bank functions as a high-velocity pipeline, moving debt from originators to global investors. When an institution originates a loan but knows it will not hold the long-term risk of a default, their incentive to thoroughly screen the borrower plummets. Volume becomes more important than credit quality, pushing riskier, lower-quality loans into the broader financial system. We see similar misaligned incentives in private wealth management, specifically regarding AUM fees and Lombard lending. A Lombard loan is a credit facility secured directly against a client's own investment portfolio. If a wealthy client wants to buy a massive estate, their private bank will encourage them to take out a Lombard loan rather than selling off their stock to pay in cash. This guarantees the bank gets to keep managing the client's original portfolio, keeping their lucrative AUM fees high. A bank's profit incentives are frequently in direct opposition to the financial safety of both the individual client and the stability of the broader market. The modern banking system operates as a sophisticated assembly of toll booths, credit factories, and risk distributors. Every customer interaction, from a grocery store swipe to a checking account balance, provides the raw material for this multi-billion-dollar machine. Understanding this invisible machinery, from the float on your checking account to the spread on your currency, is the only reliable defensive strategy to navigate the financial system and protect your wealth.